Thanks, Terry. And helping me tonight will be Shaun, one of the other tax professionals in our office. So it's a little bit of a potpourri tonight. Kind of our theme in doing it was what's new for 2014. We have a couple of federal budgets that affect 14, some rate changes, and even going to get into the Canada pension plan in a little bit more detail than maybe we normally do. So probably the first thing we'll touch on is I'll have Shaun go through just a quick review of the new personal tax rates for 2014 compared to 13, because this affects things a little bit, especially for the owner manager of a corporation. So a physician or a dentist or any other business owner who happens to be incorporated. So Shaun, can I get you to review the rates?
Sure. So the most important thing to notice, I guess, if we're comparing 2013 and 2014 for anyone receiving what we'd call regular income, so things like salary or business or professional income, nothing new, right? Those rates actually have been pretty well static for the last 3 or 4 years. Capital gains, same thing, right? Half of the regular income rate. You'll notice just a little bit of fiddling going on with non-eligible dividends that you might receive from your private corporation or eligible dividends you might receive from public companies. Just a little bit of fiddling there in those first and second column. I've got a fancy laser pointer, I'm told. Yes, just a little bit of movement. And so you kind of ask yourself, what's with the jerking around, right? What's the significance of these minute tax rate changes? And it's something done in the spirit of something called integration. And you may have heard of it. It's sort of the system that exists to make you, the taxpayer, indifferent between receiving business income directly, say as a sole proprietor, and paying that 46.41%, or operating as you can through a corporation, either as doctor or dentist or just any other professional, having the corporation pay a set amount of tax, and then you as the shareholder receiving the balance of funds and paying tax on that dividend. So in a perfect world, and we're nearly there now, I mean these dividend rates have been shifting over the last 3 or 4 years, we're nearly there that you would be completely indifferent about how you receive your funds. At the end of the day, you would have either paid the same amount of tax as an individual, or you and your corporation together will have paid the same amount of tax. What blows that all to bits is the third column now in Ontario, where there's the so-called super rate of tax. So on individuals lucky enough to make income above $514,000, say in a year where you've sold your business and cashed in, you're going to pay these extra amounts of tax that make integration not really the primary concern of the legislation, but it's that way of having the high income earners pay supposedly their fair amount of tax. And I won't weigh in because I'm not sitting in that column, but good for you if you do. We'll focus just on salaries for a minute. So if you are an owner manager and determining your own salary or those of your family members, some numbers that you can plan around. If you wish to have the maximum credit for CPP for the year, you'll be paying yourself a minimum salary of $52,500. If you're wishing to generate for yourself the maximum RSP room for 2015, and so you'll notice the way that the RSP calculation works is it's sort of backwards looking. What did you earn in the prior year dictates what you're able to contribute this year. So looking to 2015, we already have to plan our 2014 salary, and you'd have to pay yourself up to $138,500. The next RSP season coming up, we're just about to wrap one up at the end of February, but for next year, the RSP dollar limit that you can actually contribute, say you've generated that maximum RSP room, you'll be able to contribute up to $24,270 into your RSP. And then it's a small point, but we talk a fair bit later about CPP and some of the changing rules. Keep in mind that there's a basic exemption. If your salary is $3,500 or less, you won't be contributing into the program. So, Doug, I'll get you to talk about why we don't care if we pay ourselves a salary or dividend potentially.
So what I did with this next slide, I thought, well, okay, you need $150,000 to live on. That's your personal need. How should you take it? In other words, does it make a difference whether you go all salary or all dividend? If you go all salary, you're paying yourself $245,000. That nets you $150 grand, kind of end of story. If you go dividends, of course, you pay yourself a bit less, you still net out $150,000. So the question is, which is better? If you go all dividends, your corporation will have $5,074 more dollars in it. Why is that? And at the bottom of the page, it basically says, because you're not paying Canada Pension Plan of $4,800 this year, you're saving a crummy little $249, well, because integration that Shaun was getting at isn't quite perfect, but it's almost perfect. So the salary dividend decision is largely based on CPP. So we get into that in a little bit more detail in a few minutes. But the theme of this is that there's other things that will affect the salary dividend mix, but if it's just the pure tax rates, they've really got the system working pretty good. So the next slide is a little bit of a digression, but I thought I'd bring it up because Shaun is thinking about buying a new car. Now the way it works in an accounting firm is the senior tax guy gets to drive the reddest and the fastest car in the firm. That's me. But Shaun's thinking of getting a BMW 435, 300 horsepower. So that's 2 more horsepower than my car. And it's pretty red. So I got to talk him out of it. So here's the deal. Shaun, don't get your BMW. Lease yourself a brand new Honda Accord every 3 years instead. It's not quite as fast, but take the difference, these are real numbers, throw them into an RSP, and let them sit there for 35 years. How much money will be in your RSP? $944,000. Holy cow, growing at 5%. It's the magic of compound interest, and when it's 35 years, of course it grows pretty good. But I love that example, and if you show up with a red BMW,
I'm not sold yet.
Buy a horse.
Yeah, buy a horse is even better. And
I don't know which one eats cash faster.
at least go for the restricted farm loss rule. Anyway, the next slide really gets more into this salary dividend thing, and what other factors are there? Canada Pension Plan, obviously, we've talked about it. And of course, the other thing about dividends is if all you earn are dividends, you can't contribute to an RSP. Instead, you just leave your extra money in the corporation and let it grow there. That's the alternative. And it's saved up inside the corporation for retirement. A few other oddball items, childcare expenses. If you're paying childcare expenses, those are only deductible against what's called earned income. So that's proprietorship income or salary. And it gets even messier because it's the lower income spouse has to claim them. So if the lower income spouse for some reason just has dividend income, you can't claim any child care expenses, you lose. So it's situational, but nevertheless it's there. Moving expenses, same thing, can only claim them if you move, and you earn business income or salary at the new location. Alternative minimum tax, you probably only are going to see this once or twice in your life. If you buy a whole bunch of crazy tax shelters, this is an extra little personal tax that can kick in. Or if you sell shares of a small business corporation and you get to use your lifetime capital gains exemption and pay little or no tax, then you may be surprised to see that you actually owe an additional amount called alternative minimum tax that you hopefully get back over the next few years. Anyway, AMT planning is a little bit easier if you're earning salaries instead of dividends. So it's situational. There's a bit of an effect on the tax bracket you're in if you earn dividends. If you receive $100 of dividends, you actually have to report 118 or 125, some higher amount on your personal tax return, and you get dividend tax credits and all that, but it tends to push you into a higher tax bracket, so that can have an impact. Tax withholdings versus installments. If anybody here has ever been late making a payment to CRA for tax withheld from salary, you've been run through the mill. There's a penalty of, it can be as high as 10% just for being a couple of days late. Yikes. And you have to remit it every month. They're like tigers trying to collect those amounts. But if all you earn are dividends, you just pay your quarterly installments. And as a matter of fact, you only pay them if you have to. We have some clients in our office that didn't have to make installments. They just have to make this great big tax payment coming up April 30th. So they get a whole year of using the tax, or having their tax money in their account instead of having to pay it in. A couple of corporate concepts. I hate to go into this in too much detail, but there's income that's earned by a corporation from portfolio investments, interest or dividends or capital gains, and that generates some odd account balances in the corporation. This thing called refundable dividend tax on hand, for example, basically means that if the corporation pays you a dividend of $3, the corporation gets a refund of $1. Now you're going to pay less than $1 personal tax, and yet the corporation gets back a full dollar of its refund. So RDTOH, refundable dividend tax on hand, probably should be kept at a minimum amount. That's the number you can actually see on the jacket of your corporate tax return if anybody ever bothers to look at it. I don't see a lot of people pouring through the corporate return too often, other than other accountants. Capital dividend account balance is the same thing. You'll recall that we only pay tax on half of the capital gains. What happens to the other tax, or the other half in the corporation? It's not taxed, and it can be paid out to the shareholder tax-free. Bottom lines may be a little bit more interesting in the sense that a salary has to be reasonable. Shaun will talk about this in a minute, but a dividend doesn't have to be reasonable. We can pay a dividend of whatever we want subject to corporate law. So we don't have to worry about CRA writing a letter to us saying, well, what did the spouse do to earn the salary, and blah, blah, blah. So those are sort of the subtleties. Next slide. Sometimes I'm asked the question, well, who should make my charitable donations? Should it be the corporation, or should I make it myself? Crunch through the numbers in some detail, and it's ever so slightly better to make them in the corporation. Now, it's way better if they're made in the corporation, but the receipt shows up in your personal name. But that's a more of an ethical dilemma. Gee, what do I do with this? Anyway, we'll move on to part 2, where we'll look at some of the rules for old age security and Canada pension. We'll start with...
Before you totally this tax-free savings account.
We're talking about those a little bit later.
Oh, okay.
Any other thoughts before I move on to old age security? So just a quick summary as to what it is. It's about $6,600 a year. It's indexed. And there's a 20-year residency requirement. So you have to have lived in Canada for 20 years or it gets prorated down. It's clawed back once your income exceeds $70,000, and it's all gone by the time your income's 114. In other words, you don't get any. And that's been around for, 15 years or so. And there's been an awful lot written in the papers about how to avoid clawback, and I think a lot of it is pretty short-term thinking. But nevertheless, something that was new last year, starting in June 2013, you can defer receiving your old age security. I don't want to receive it at age 65. Instead, I'm going to wait. And I can wait up to 60 months. So for every month I wait, my pension goes up by 0.6% per month. So that's kind of interesting. It's not big numbers, but my OAS can jump from 66 up to about $9,000. So who is this of interest to? You continue working after age 65. Well, gee, I'm going to be making my $120,000 anyway. Why would I want to apply for OAS? I got to give it back. You have to worry about some health issues. So if you don't make it to age 70, well, you've lost the big gamble. Or perhaps your income drops at age 70. You know it's going to drop at age 70, but not until then. Or even the last point, what if you just retire in the middle of the year? So you know your income this year is going to be big, but next year you're retired. So don't receive your OAS for 6 months, and it'll increase by whatever that is, 3.6%, just by retiring, I suppose, in the middle of the year. Canada Pension Plan is one of the bigger themes tonight, because I think there's, again, a lot written about this, and I thought it's worth reviewing some of the rules. So what's the basic entitlement? At age 65 today, if you've maximized your contributions for all 40 previous years, it's $12,460, not much. You can elect to start receiving it at age 60, and we don't have to play the funny little game anymore that you're going to fake your retirement. You just ask to start receiving it. Or if you want to defer it, you can defer it to age 70. And again, the factor is 0.6% per month. So it just goes down or increases based on those numbers. Bottom of the page, I mentioned that you can split it. So if you happen to be Ward and June Cleaver, the couple from the past where one had high income and the other had nothing, you can simply apply to the CPP people to split the pensions. They turn around and issue 2 checks instead of 1. And of course the recipient just reports it on his or her tax return. That can happen, or it typically happens on divorce, but that can happen while you're happily married. It doesn't matter. So if you're Ward Cleaver, you'd want to look at something like that. Some of the new changes last year had to do with post-retirement options. So the first point here is that you have to keep on contributing to CPP all the way up to age 65. No choice. Even if you've already so-called retired and you've started to collect it, you got to keep paying anyway. So that's up to age 65. After that age, you optionally can keep on paying it. Well, gee, I'm 66, I'm going to work this year, I still want to contribute. And if you contribute the full amount, then next year your pension goes up by $311. So that's a lot of money to pay for maybe not a very big benefit. And of course the cost you would pay age 65 to 70 is whatever the annual maximum is, which this year is about $4,800. So what are these basic calculations? How do they figure out what your pension income is going to be anyway? I actually got onto the website about 3 weeks ago and I registered myself. I got my double secret password in the mail and I logged on to see what it looked like. So I got to go back and see how much I contributed in the years. I think I've been working for 32 years or something. So in most of those years, I hit the maximum. Now back in 1982, I only had to pay $130. So I didn't pay very much in those years, and yet that still counts as a full year. So all I need are 40 good years to maximize, and it doesn't matter which 40, or if I only have 30 years, I'll get 3/4 of the pension. So my past history is pretty good for me. The trouble with you, Shaun, is you don't have much of a history. You've only been working for a few years. Your years are costing you $2,000 or $3,000, and it's going up every year. So anyway, I get my 40 years. What percentage of the yearly maximum did I contribute? Add that up, divide it by 40, multiply it by that $12,000 number, and that's simply my pension. It probably is worthwhile logging onto the website and just double checking your history. If you've worked for companies maybe in the past that had unsavory CRA history, maybe they were kind of bad at remitting their tax deductions, or they were an out-of-province company, you're just not sure, you want to check that and get the records rectified. Even worse, maybe you worked in Quebec for a few years. You can transfer your Quebec history into the CPP, but I've only ever done it once, and it was about a 3-year process, so yuck. But you just want to make sure it's right. Anyway, where's Vic? Okay, I got a question for you, Vic. And this has to do with 2014. So you're a successful guy, you can choose dividends or salary. Yeah, you contributed in the previous 20 or 30 years, whatever it is. But here's a 2014 question. Vic, you can take all dividends or you can take all salary. If you take salary, you got to pay $4,800 to CPP. You pay half, your corporation pays half. So that's your cost, and here's what you're going to get. A pension at age 65 of $311. What are you going to do?
Bad deal, Doug.
How long do you have to live to get your money back?
172 years.
Something's wrong there, but I can't do it in my head either, so I don't know the right answer.
11, 12 years.
Sorry, does somebody know them?
11 or 12 years.
15. Well, It's got to be more than that. It's got to be about 15 or 17 years. We're the accountants. We should,
Yeah, right.
we should know the answer.
What is the answer, Doug?
So you got to live to 80, Vic, just to get your money back.
On
So-
that 1 year contribution, exactly. And you keep doing it.
So
Each
so
year
it's a,
you're pushing it
yeah,
up.
it's a year-by-year decision. So I think I agree with you. Skip it this year. Just go all dividends, and save the 4,800. And what are you going to do with the 4,800? You're going to very faithfully put it into some sort of retirement vehicle. You're not going to go out and spend it and have fun. That's what everybody says. So what concerns might Vic have if he chooses that? Well, a little bit of concern about indexing. Yeah, our CPP income goes up with the rate of inflation. Inflation's not a big deal right now. I'm a little bit of a child of the 70s, though, when it was up around 12, I don't know what it peaked at, 14 or 15% one year. And so you would have liked those days, Shaun. We were getting raises when I was back in my accounting firm early days, 2 or 3 times
Now
a
he
year.
tells me.
I think I got 3 raises one year, not that I earned any of them.
Yeah, right.
The other thing maybe Vic could worry about are retroactive changes to the legislation. Not a big worry, but what if all this talk about retirement income, the government actually does something good for us? You might be left off the bandwagon. I wouldn't worry about that either. And then the other thing to worry about, Vic, is does this affect any of your other CPP benefits we'll get into? Retirement income is just one of them. So the first one are the disability benefits. A lot of people don't even know this, but if you're paying CPP and you become disabled, you're entitled to a disability benefit. I know a few people that are receiving these. It's under age 60, it's $450 a month plus. Plus depends how much you've contributed in your past. So that's not a huge amount, but it's not bad. Age 60 to 64, well, you're saying $450 a month, but at that point you might choose to receive your retirement pension early. So you're getting both pensions, your disability pension and your retirement. And then once you turn 65, you just get your basic retirement pension, whatever that works out to be. So to qualify for this, you have to be disabled. That's not the income tax definition, and I'll just leave it at that. It has to be pretty serious. You're unable to work. But it doesn't not have to markedly restrict your day-to-day activities. That's the difference in the definition. Now, secondly, and this is maybe a little bit more important, you have to contribute to CPP in 4 of the last 6 years, or 3 of the last 6 years if you've contributed at least 25 years. So what this is kind of saying, this is, where's Justine? What if you pay yourself a small salary, Justine, maybe $4,000 or $5,000? So technically you're contributing. You're paying maybe $100, $150 a year to CPP. But you're then entitled to that disability benefit. Is that a pretty good deal?
Seems like a no-brainer to me, Doug.
Did we rehearse this? So by just paying that small salary, you're paying peanuts to the CPP plan. You're on side with the 4 or 5 year rule. And the other little benefit is your first $1,000 of employment income gets the employment tax credit. And that's worth $250 a year to you. So even, Vic, if you go all dividends, pay yourself, I don't know, $5,000 a salary. And do it in one lump sum payment to minimize your headaches, I guess. Children under 25, it's actually children under 18 unless they're at university. If one parent becomes disabled or dies, that child receives our $229 a month survivor pension. I used to call it the orphan pension, but you don't have to be an orphan. Just one parent dies and you're entitled to it. There's also a death benefit. You die, you get $2,500. Last one is the survivor benefit, and this is payable to a spouse. And it's the Income Tax Act definition of a spouse, so married or common law. Anyway, what happens if the survivor is 65 years of age or older? The survivor gets a pension of 60%. If the survivor is between 35 and 64, it gets reduced. And if the 65-year-old, I'll have to use the word guy, dies leaving a 33-year-old spouse, then that spouse has to wait till she's 65. Wow, that's a big age difference. And those amounts are also adjusted a bit if there's a disability thrown into the mix. So I think anyway, my conclusion out of that is CPP is a year-by-year decision. Know what your history is, and maybe just contribute a little bit so you get some of these other benefits. But otherwise, I think like Vic said, it's a pretty horrible investment. Anyway, do you want to comment on any questions on CPP before we move on? If not, I'll get Shaun to talk about spousal RSPs. They are still around.
Right, so this is an interesting mix of our conversation about income splitting and retirement income planning. And it's something that we can all be working on now, essentially. Just for anyone who hasn't utilized a spousal RSP before, I'll just, for 2 seconds, explain the mechanics, whereby one spouse is earning the majority of the income and the other spouse is not. So I certainly have the cash to contribute to an RSP, but I forecast perhaps that my income will always be at some high level. So I'd like a mechanism to get some of my retirement income into the other spouse's hands, right? I can contribute to a vehicle called a spousal RSP. It still burns my RSP room, so I'm generating all this RSP room based on my salary and contributing to an asset that I don't own. My spouse is the beneficiary and the owner of that RSP. But we have other mechanisms to do that, right? You remember it was 2010, I believe, that pension income splitting came into effect. So if you've got RIF income or money coming out of an RSP and at least one of the spouses is 65 or older, you have the ability to split that income to a maximum of 50%, right? So that's not bad. But spousal RSPs have no such limit. Because your spouse, the lower income earner, is the beneficiary of that RSP and will be receiving that income, 100% of the income that comes out of the plan is taxed in their hands. It can be beneficial, like I said, where the earnings are significantly different. You can also take advantage of the age gap that Doug just outlined, where there's 10 or 20 or 30 years between it, the time at which you have to convert your RSP and start taking money out is reliant on the age of the younger spouse. You're waiting longer, and that's great if you don't require the cash flow anyway, right? You're deferring income further into the future. It's also useful in time of separation and divorce. There's already assets in the hands of the other spouse, and if you've been the high income earner, you know that there's going to be a big payment coming from your account to his or her account. So if some of those assets are on the other side of the fence already, it puts you in a slightly different, or better perhaps, I don't want to use that word, but in a different negotiating position rather than you necessarily having to write such a big check.
This slide sort of gets to the preferential tax rates on capital gains or dividends. Capital gains are taxed at half the normal rate. Dividends are taxed at a little bit more than half the normal rate. So let's talk about retirement pools of money. A lot of people in the room probably have two. They save within their corporation, and they also save within an RSP. This slide simply says that you should be earning interest in your RSP, but you should be earning capital gains and dividends within your corporation, subject to your portfolio mix. And that's simply because of the tax rate differential. All money that comes out of an RSP is fully taxed, even though the RSP may have earned some capital gains. It's always been that way. That's been criticized in the press. That's just life. That's the way it is. So it's kind of integrating the investment plan of the corporation and the RSP is really what this is getting into. Now, I thought I could do a 35-year, the magic of compound interest sort of thing calculation again to prove how much smarter this would be. I wouldn't bother. We're probably well in excess of your car example, though, if you could perfect this.
Yeah.
So do you want to cover off tax-free savings account, Shaun?
I do, yeah, to address your point.
So we're not. Sorry, there was a question.
Oh, sure, I saw you.
Does it matter if the dividends are Canadian or U.S. corps? Dividends are from a Canadian company versus a U.S. company?
Dividends from a U.S. company will be subject to withholding tax at the border. So that's the difference.
Yeah, but not an RSP.
The dividends into an RSP still, yeah, there's withholding tax. And that as well, I believe. I can't say for sure, but.
So you kind of lose that withholding tax if it's earned into your RSP. So there's a slight advantage. I shouldn't say advantage, but probably those should be owned in the corporation. They're fully taxed, unfortunately, just like interest, though. So it's a withholding tax question. So if there's any withholding tax, earn it in the corporation. If it's zero or if it's trivial, then the answer is RSP.
Just going on that theme, if you are really keen on investing in the U.S. economy and you have more investments than what is allowed under the U.S. rules, meaning that you are subject to U.S. taxation, especially on debt, if those investments are in your corporation when you die, are those U.S. investments taxable?
I believe not, but I'm not 100% sure on that. Would anybody else know the answer? Any of the other accountants in the room know the answer to that one? I don't
actually do. It was the trick question. I just faced it. That's why I asked the question. If you really like the U.S. and you put it in your corporation, or sorry, you hold all your U.S. investments to yourself and it's over the exemption amount, then you're not, if you own it personally, then you're subject to U.S. estate taxes upon death. But if you hold it in your corporation, you're not.
And there might even be a look-through rule for some weird corporations that are nothing but investments.
It could happen.
Perhaps.
That's my
We
guess.
haven't gotten there yet, but anything's possible right now
Yeah.
with the U.S.
It's sort of simple. Because corporations never die, they're not subject to estate tax. That's the standard answer.
Personal exemption is 3.5 million.
It's 5 million now, isn't it? 5.2?
5.2 or something, right around there, yeah.
Yeah, 5.2 million, but that's your total worldwide assets, including your insurance proceeds at debt.
Yeah. So that exemption is not, like, it's based on the percentage of your U.S. assets relative to your total estate. So you don't automatically get 5.2 if you've got 3 million of assets on debt. You have some ground down exemption. So it's just worrying about that, what proportion of your estate is U.S. based.
So what ends up happening is that, let's use the number of 5 million exemption. So if you don't have an estate worth 5 million today, don't worry about it. But if you have an estate that's worth 10 million, which you could, because it includes your insurance, your house, your RRSPs, absolutely everything, and your exemption is 5 million through the U.S., it reduces your actual U.S. exemption to 2.5. So if you've got more than $2.5 million of U.S. assets, then you're subject to U.S. estate taxes.
The trouble with U.S. estate tax is that it's not an income tax. They fiddle with the Canada-U.S. treaty on that, so sometimes you can take advantage of it. But normally, if you have to pay U.S. income tax, you get a dollar for dollar reduction on your Canadian tax return. But that's only for U.S. income tax. U.S. estate tax may or may not be creditable that way. Depends on the asset and whether it's actually increased in value. So there can be a real problem with that at times. Anyway, any other thoughts before Shaun moves on with tax-free savings
We're going
accounts?
to take you on a different direction, but I just thought since we're talking about U.S., it's a major issue this year. And we've run into it with an estate.
Right.
Absolutely.
So I don't have numbers up here because it really is just, I'm going to do just a quick overview of, maybe you're thinking, again, we've talked about investments inside your corporation versus inside your RSP. Let's assume then that you're not using a corporate vehicle for savings. I think we're all pretty familiar with the rules here comparing an RSP to a tax-free savings account. If I'm using a tax-free savings account, I'm making those contributions out of tax-paid money. So I've earned my salary and paid my tax. Whatever I have left, I can potentially invest into this account. Whatever I make inside that account, completely tax-free so long as I live. And on death, right? There's no implications at any point on the income inside the account. In fact, even the earnings inside that account then further increase my contribution room. So if you'll see in the point there, if I'm really feeling lucky and I invest the maximum amount in my TFSA and I triple my money, so now my $25,000 contribution has created an additional amount of room that stays, even if I pull that money out of the tax-free savings account. So it's a really interesting vehicle if you're looking at items with high return or long-term growth or whatever it is. Not as nice as an RSP if you're looking for an immediate tax deduction. If your objective is like mine and Doug's, pay as little tax as possible, well, of course I'm going to want the contributions I put into my savings to be tax deductible today. And I get a little bit creative even and figure out, contribute a certain amount to my RSP to generate a certain tax refund, and you can just run yourself in circles a little bit to figure out optimum contributions every year. But I don't get that with my tax-free savings account, so I'm not a huge proponent, but that's just me.
Yeah, my thought is sort of, it's more like, it sounds demeaning, but it's not. It's blue-collar tax planning. Because if all you get is a T4, there's not much you can do. Take your extra savings and put them in a tax-free savings account. That's it. You don't pay tax on the interest. But if you're already incorporated, the choice is leave $8,500 in your corporation, or take it out and put $5,000 after tax in your tax-free savings account. Why bother?
Why have both, right? The corporation is itself a savings vehicle paying the lowest rate of tax you can access. So it's a little bit redundant in some cases.
The problem with the RSP, they make you take it out at a certain age, and then you have
Sure.
to add on your other income.
Yeah. And it's taxed as regular income, which if you've earned a significant amount of dividends or capital gains inside there, you don't get the benefit of those lower rates of tax. So sure, there's things to think about. But it's just that deferral that we like, the immediate deduction, the ability to use our tax-free fund from the RSP contribution to make further contributions, or you can just go on and on. So long as you have room, the tax-free savings account's hobbled a bit. That way, low limits and no deduction at the time you contribute.
Are they increasing it this year from 5,500, or they're just talking about it?
No, that happens automatically. So it's an automatic 5,000, and then it became 5,500, and it'll probably be another 3 or 4 years before it's an extra 5,500 each year. It'll become 6. Yeah, it's no forecasted change that I know of to stopping the TFSA program or freezing it or whatever.
So your assumption is based on taking money out of the corporation in order to put money into TFSA.
Right.
If you have an investment account where money is growing anyway, you can take that out and put that into TFSA and don't have to pay anything on what you get.
And that depends on your asset mix, or just acknowledging the fact that your corporation is the entity making the money, right? So you're either going to invest inside the corp and have it pay a little bit of tax, or you're going to have to get it into your hands before you can have a tax-free savings account. So there's a cost to using these accounts, right? It just doesn't necessarily.
Most of us have come into incorporating in the last few years.
So you might have both, right?
So
You
for
would
years we were working and putting money, investing into non-RRSP and investment accounts. So in some ways, when you say this, surely if you are taking out purely out of corporation for young physicians to pay into TFSA, that may be a different strategy. But certainly it's a good strategy to put money into TFSA from your investment account.
It's great if you're looking at high returns, right? It's if the cost of taking the money out into your hands and then putting the net amount into a TFSA, but you can guarantee yourself some sort of rate of return that made it worth it, then yeah, it's an absolutely useful vehicle. You can't see into the future though, so it's still, it really depends on the individual, right? No harm in having both vehicles.
No, but dollar to dollar, even if you're making less money in your investment account, even if you make $10 in your investment account, and you're making $10 in your TFSA, that $10 is purely tax-free. So
how do you?
All he's saying is that he has 100,000 in non-registered funds.
Well, he paid tax on it at some point, though. That's the thing. It was never just free money.
You have 100,000 that I pay tax on, sitting in an investment account where I'm paying tax personally on the investment account. It does make sense to move $5,500 from the non-registered investments.
Move to stocks that don't have huge appreciated gains, right? Because you're going to have a disposition when you move from the non-registered account into the TFSA. So yeah, move some flat amount into it. Absolutely use that room if you've got the cash and ability to do so.
Then the other point too is if you do have this money outside, like personal cash, just take a smaller dividend and spend your savings. Use your bank as your corporation as your investment vehicle rather than your personal account. So slowly save up more in the corporation and slowly start spending your investments. So in other words, only take out what you need to live on is sort of what I was getting at. But you're absolutely correct. Why pay tax on the interest when you can save the tax by using the TFSA?
The advantage of the TFSA, though, it doesn't count to the OAS clawback.
Well, no, because it's not income, right? Yeah.
Well, but you can still pay yourself that money in retirement, and that will keep you below the OAS clawback.
That's correct. And that's assuming that the tax-free savings account will be around in 20 years. It's growing at $5,000. The amount we can put in is growing at about $5,000 a year. 10 years from now, your TFSA will be 100 grand. Who knows what party is going to be in power, but that's going to all of a sudden look like a tax goodie for the rich, and they'll get rid of it. So, you know, when we're trying to project a whole bunch of years down the road, I see this as going someday.
Yeah, but RRSP was 7,000 30 years ago. I mean, now it's 24,000. So
Yeah.
how do we know? TFSA may go up to 25,000.
It might. It might.
The interest that's earned in a corporation, that's called passive interest?
It's yeah, aggregate investment income is the official term, but yeah, it's not doesn't benefit from those low tax rates that you get in a corp.
So is it taxed less, the interest earned in the corporation? Is it taxed less or taxed as an individual? I thought it was taxed higher.
It's
than
taxed at
corporate tax.
it's taxed at 50%, which is an awful rate.
Yeah.
But 30% of that is refundable when the corporation pays dividends. So that's your RDTOH account. That $30 extra you had to pay goes into this RDTOH account. The corporation gets it back, and basically you have to pay it.
So it's artificially higher. Yeah.
Oh, okay.
Okay, we've got to stay on time a little bit so we make sure people get home.
The next slide has to do with IPPs, individual pension plans. And I'm seeing more and more of these cross my desk. So basically, what the heck are they? You have to be an employee and not self-employed. It's a pretty serious contractual arrangement. This is about the most highly regulated thing I've ever seen. We have the feds, we have the province, and they're all sticking their oar in to try to regulate these things. But what it does, if you have one, is it turns you into a public school teacher. Suddenly, you're now the beneficiary of a defined benefit plan. So what happens is, hey, when I retire, I get a pension of $80,000. So that's kind of cool. But what does that mean to the IPP? They have to fund it. So you have to contribute, your corporation has to contribute to the IPP. Every couple of years, some actuary comes storming in and says, hey, there's not enough money there to fund it because you have not invested maybe very wisely, or the market tanked, or whatever. So corporation, you're going to have to pay in some more. So the corporation gets a deduction for that. That's kind of neat. What happens to the rest of us when our RSP doesn't do so well? Well, I got to work another year. But in this case, we get that extra actuarial type adjustment. And the flip side's actually also true. If our pension plan does wonderful in the market, we may never be able to contribute again. But that'd be pretty good too. But we're funding our $80,000 a year pension, or whatever the number happens to be. But it's actuarial science. That's all it is. So do you want to go through some of the family tree points we have, Shaun?
Right, so this is a section dedicated entirely to income splitting. So one of the big perks, obviously, of running and owning your own company, right, is involving your spouse, involving your children, and depending on how you pay them, their involvement can be great or minimal, but I'm going to share with you some of the benefits. And you have to understand, we summarize the numbers a bit, but if you're comparing an individual who earns a significant salary by themselves versus splitting that salary 50-50 with his or her spouse, we're talking about an actual tax savings using 24 rates of about $18,000 as a combined unit, right? So you're taking advantage of the other person's graduated tax rates. You start at a low rate, and as you earn more, you're subject to higher rates of tax. If then you're also splitting with your children who might have additional tax credits, right? Tuition credits, you're losing, certain credits for your children, the amount for children or eligible dependent or something, but the children are generally subject to lower rates of tax, especially they're not making anything while they're in school. So we're talking about savings in excess of $20,000. So it's something to think about. And I'm going to talk specifically about salary on the next slide because there's other considerations. Two that I don't talk about extensively, but you have to think about, is the CPP cost of paying a salary to these family members, right? We've said the number a few times. If the maximum CPP contribution in 2014 between the employer and the employee is about $4,800. So if you're paying your spouse $50,000, yourself $50,000, you've now contributed twice. It's a significant amount of money when you start adding everyone up. You also have to consider share ownership. If you're paying dividends to your spouse or children, do they own the appropriate class of shares? Do the shares allow the payment of dividends? Does it cause you to also have to take dividends if you have some higher ranking class of shares? And are those children over 18? There's ugly tax consequences to paying dividends to minors. So just some things to think about when you're looking at compensating your extended family. Specifically in the employment realm, there's a reasonability test, right? So Doug mentioned earlier that if you're paying dividends on shares, there's no need to earn them, right? Dividends aren't earned just by virtue of being a shareholder of a specific class of shares. You're naturally entitled to dividends, from $1 to $1 million, depending on, whatever corporate law restrictions there are or what's written into the articles of the company. There is an extensive reasonability test, especially in the eyes of CRA, on the amount of salary that you're paying to someone. So you can certainly give your spouse that $50,000, but what did they do to earn it? And are you paying it at a market rate? So in an audit situation, the CRA is actually reviewing the relationship between you and your spouse, the employment relationship, and comparing it to an arm's length relationship, say between Doug and myself and what NPT pays me. We get the question often as well, how old should your kids be before you hire them? Well, there's no magic number, right? It depends on whether they're actually doing the work. And are they being compensated at market rates? Staying with the audit theme a little bit, not to sound negative, but this is a big, easy target for the CRA, right? If they may start reviewing your books and records for a reason related to business losses, and it has the tendency to creep, from that original objective. Well, where do those losses come from? Well, what salaries are you paying? Who are you paying them to? And so I've had to defend, in many cases, what did you pay to the spouse, how much, and how is the big question, right? Did you just pay them by journal entry in the books of the company at the end of the year? Well, they took about $40,000, or they did work worth about $40,000. If you're expensing a salary inside your company for the spouse, it really does have to walk and talk like a salary, as again, like with any other employer, remitting source deductions on time, actually cutting a check every month. So it's just a bit of caution, I suppose, that salary as opposed to dividends is a little bit more hoops to jump through, but it can be very advantageous, like you saw with those numbers, to splitting that income and sharing it among the family members. Doug, there's other types of income that can be split that I'll pass off to you.
This is just a quick review of the capital gains exemption. So our sort of pretend taxpayer that we imagine is getting older, is finally selling the business, and eventually is going to die with the last slide of the presentation. But just a quick review of the capital gain exemption itself. I think everybody knows that you can sell shares of a small business corporation for a gain of up to $800,000, and it's all sheltered with the lifetime capital gains exemption. But there's some ugly rules we have to plow through to get there. The first ones are the your personal tax history. In theory, I would need to look at every tax return you filed since 1985. Those are now long gone into the garbage, so you can get that history from CRA. But for example, if you've ever claimed what's called an allowable business investment loss, you invested in some small business that tanked, that's going to screw up your capital gain exemption this year. Or maybe you've been into tax shelters, that's going to screw it up. So I got to get that history from CRA. Some of it I can plan around, and some of it I can't. So it's that able thing I mentioned, there's nothing I can do about it. But if you have excess investment expenses, maybe I can fix that problem by having you pay more dividends this year. So anyway, that's the personal side of life. Then I have to look at your corporation. I have to look at, I'm not going to say the balance sheet, because there's things that aren't on the balance sheet. I have to look at your corporate assets. What are they and what are they worth? What's the fair market value of them? So some of those assets are going to be business assets. Think of a dental practice with goodwill. Maybe not on the balance sheet, but that's pretty valuable. So what's the value of the business assets versus what's the value of the investment assets? And that's actually a trickier question you asked earlier. Is interest you earn, is that passive or not? Not a simple answer, but an investment asset is not used in the business. It's not needed to run the business. It's clearly something other than that. So a huge stock portfolio or a rental property or something might be an investment asset. So anyway, I do these calculations, and I have to be able to say that in the previous 2 years, your investment assets weren't more than half. And at the moment in time you're selling the business, 90% of your assets have to be business assets. If not, you don't get any of your capital gain exemption. So this requires a little bit of planning sometimes ahead of time. There's actually one dentist in our client base who didn't want to do any planning up front, then showed up and said, I want to retire. Well, too bad you don't get your capital gain exemption. You have to work for another 24 months. We told you so, but you didn't want to come in and do the planning, so ha ha, it looks good on you. We didn't say that, but we kind of thought. So he's into his countdown. I think he has 3 months to go, and then there'll be a practice up for sale. So it all boiled down to that 50% number. He was like 70% investment assets. He had a successful practice, and he generated a lot of extra money. He saved it. He did all the right things, but it put him offside with that 50% test. So sorry, we had to fix it. Then he had to keep working for another 2 years. Last point is kind of a little one, but it has to do with share ownership. What are the attributes of the shares? If you look down some balance sheets, you'll see, Class A common, Class A special, B pref, C, redeemable, retractable, and all this sort of nonsense. What that's telling you is that a share is not a share. I have no clue about the share that you own until I go and read the Articles of Incorporation that describes the contract between the shareholder and the corporation. Some shares increase in value, and some are just stuck at $1. So you really got to see that. So the next slide kind of deals with a funny situation where we've used our fancy shares. So it's actually a real story from a couple of weeks ago in our office. We have a dentist who has used his capital gains exemption. He sold his practice. He got, whatever it was, about $900,000. It was almost all tax-free. But he wanted to set up another practice in the small town where he's living. He's only 50-ish. So he's going to start practice number 2. So he kind of looked at things. Well, eventually you're going to sell this practice in all likelihood. Your capital gain exemption's gone. What about your wife's? So here's what we set up. We set up our dentistry professional corporation, and he owns 1 voting common share. His wife owns 999 non-voting common shares. The only difference is the vote. So when this business gets sold, who's going to cash in? The spouse. She's going to use her capital gain exemption. And she's a public school teacher, so boo, but... So the college is completely happy with this. The college says voting control has to be with the dentist. Other than that, they couldn't care less. So we have to describe these shares pretty carefully in the Articles of Incorporation, but that would be the tax-free second sale. So he kind of flubbed things in his life. His first practice probably should have been owned 50-50, but it wasn't. But anyway, that was remedied when the second corporation was set up.
Doug, would you make a comment on why MPCs then typically don't qualify for the capital gains exemption where dental or DPCs do?
Most medical corporations, first of all, they can't be sold to another physician because there's no business assets to buy. So there's no, let's call it goodwill. There's really no goodwill to sell. But when you look at most of the balance sheets, at least that I see, there's a nice big portfolio of investments, and then there's, you know, a couple $100 worth of medical equipment. There's just not much there. So that corporation is clearly offside with the capital gain exemption. So when the physician retires, well, you have a corporation with a bunch of money in it, and you pay it out to yourself as you need it. It becomes an unprofessional corporation on retirement, I guess. You change the name, you stop paying your college dues, but it's just the same old corporation. But I myself have not seen an MPC actually sold.
It would never qualify anyway, even if you could sell it, just based on the amount of passive assets.
Probably if it had some weird sort of license that was hard to get, then we're talking. But other than that, is there such a thing as an X-ray type of license that a physician might acquire that's hard to get? It has to be something strange like that.
There's comments now that maybe some of the family practices that are involved in the FITs, the family health teams, you know, could be valuable at some time in the next few years, but I've never ever seen a medical practice sell.
You would think, you know, if you have a nice roster of patients and you want to retire and the new person comes along, it's just kind of a one-stop shop. It'd be kind of nice. You'd think there could be some value to it. But
well, right now the problem is that if you're a specialist, you may need hospital privileges in order to run that practice, and that's becoming pretty difficult to do, to get the hospital privileges, so that's kind of one of the issues too. But, I mean, you know, things change, eh? It happens all the time.
Practices were sold in the 80s and early 90s.
Yes, that's true. Yeah.
But you know, ever since there was a shortage of physicians,
yeah,
it's not been an issue at all.
I think you're right, though. Like, keep an eye on it as the years go by. Something might change. Quick comment about medical expenses, Shaun. Or sorry, gifts and loans. Sorry, I'll skip the slide here. Just a comment about making gifts to other adults, basically your children, I suppose, or loans to adults. Are there any tax implications? If it's a gift, there's nothing. Make whatever gift you want. There's no gift tax. It's just a big nothing for tax purposes. There's a family law implication on gifts, but that's about all. What if you simply loan money to another family member? Your daughter's off to university, you loan her $1 million. Here, go have a good time. So the interest income, if the only reason you did that was to try to save some tax, that income's going to be added back to your tax return. Because the purpose of what you did was to try to save some tax. This is Tax Act lingo. The purpose of the loan was blah, 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 and the income gets added back to the first person's tax return. But if it's not the purpose, then there is no attribution. I've seen no tax cases on this, but it's in the Act.
Are you talking about loans out of a corporation or person?
This is personal loans.
If you establish a line of credit, for example, a prime rate line of credit or something that you would establish otherwise on your house or something else, having as a guarantee the asset in your corporation, is there a tax implication? You just have to pay, I guess, the interest to the bank, right?
So the corporation guarantees the bank loan to the daughter, that sort of thing?
Yeah, a bank loan to a credit line that you can use as you wish, right? Yeah. So for example, can you have $100,000 in the corporation, in a GIC, then create a credit line so you can have a credit line that works like a bank account outside. You take and put in back whatever, you just pay your interest like the prime or whatever the bank establishes and you keep going. Can you do that?
No particular tax implications of doing that.
Okay, thank you.
And it depends what you do with the borrowed money. Maybe the interest is deductible. So gifts are no problem. Loans are potentially an issue. What about gifts or loans to children? And it really depends where that income is coming from. If dividends or whatever are being paid to the child might be subject to kiddie tax. Your child is a shareholder of your corporation. You pay dividend to that kid. That kid has to file a tax return under 18 and pay tax at the very top personal rate on the first dollar. So it doesn't really work. So that was the kiddie tax of about 15 years ago. What if you simply make a gift or a loan to a younger child? Well, the interest, income, or dividends are added back onto your tax return anyway, but the capital gains earned by the child belong to the child. So there's a little bit of a tax play there with respect at least to capital gains. CRA is very slack, incredibly slack about enforcing the attribution rules. The world's full of stories of people who have simply put money into somebody else's name. The T-slip comes out, they report it, and CRA ignores it. So it's the law, they don't enforce it, and we're all living in the real world. But the rules, nevertheless, are still there. Anyway, a quick comment about medical expenses. Shaun.
Right, well, we're still on the family tree and talking about family medical expenses. And again, we've talked a lot about income splitting and using your corporation to its best advantage. So there's a neat little thing, and some of you may benefit from this with your employer, being a participant in something called a healthcare savings account, where you're just given a certain amount of money during the year that you can spend on eligible expenses. Anything that you could deduct on your tax return under the Income Tax Act is an eligible expense, and you just have this fixed amount of money, and it's available to all employees in the business, and that's a requirement actually for this to work. It's not taxable to you, right? So the corporation is actually taking a deduction for the amount it pays you or reimburses you for these expenses. So that's pretty fancy because ultimately you're not out of pocket, and the corporation's getting a deduction against its tax payable. This compares really, really favorably to medical expenses. You're paying out of pocket, so you're just taking your salary and paying tax on it, and then having to fund certain medical expenses. You can actually lose out quite a bit because you'll know that there's that minimum threshold test for medical expenses, 3% of your net income, up to a certain maximum, and then you start getting credit for medical expenses. No such threshold with the healthcare savings account. So we just ran some quick numbers saying for a family unit, on $10,000 of expenses, you're going to save about $3,000 going the spending account route. It's interesting, it's 50% savings with the second example. If you've got only $2,000 of expenses, you're saving about $1,000 as a unit, given that, on your personal tax return, you may have gotten no credit for that. It might not have been over that minimum expense threshold, so there's a lot more benefit to the healthcare spending account.
So this is turning into a public school teacher. They'll get free dental coverage. They go to the dentist, they get some work done. There is no taxable benefit to the teacher. The money is all paid for by the board. It's just putting you in an equal footing. So this is not really crazy creative tax planning. This is fairly mundane, standard stuff that healthcare spending account, Shaun, not savings account.
Oh, did I say savings account? I suppose you're saving something. It just, like I mentioned as well, it's a fairly serious contractual obligation, right? It's not just something that the corporation can flip you a check because your child needs braces, right? It's something that's formal and can be administered externally as well. If there's privacy concerns that, your employer doesn't want to be, picking through your medical claims, there's outside administrators that can be employed as well. Just wanted to mention that.
So before we die, can you comment? Can you comment on taking money out of RRSP versus from the corporation as an income?
Sorry.
Withdrawing money from RRSP before age 65 compared to withdrawing money from as a dividend from the corporation.
It's just a personal style thing, but I think I'd be tempted to leave the RSP alone until I was 71.
Because?
Because I'm not paying any tax on the income that it currently earns year to year. And that's probably the only thing. I mean, taking dividends instead of RSP income, I'm probably going to be clawed back a little bit more on my OAS, but I don't care about a couple of grand there. But I want to start working that corporation down so that by the time I die, there's nothing left in it, or I'm subject to capital gains tax on death. And the RSP, of course, when I die, I'm taxed on that one too. So it's sort of a style thing, but I think I'd be tempted to leave the RSP alone until I had to touch it. But, what's the age of your spouse? Do you have a spouse? There's a whole bunch of questions out there. Not a great answer, but I don't know what else to say.
The reason I was asking is that is that one of the things about, let's say 71 when you have to convert it to RIF, I mean, one of the comments you've been making all along is how to save on paying taxes on the extra or clawbacks and things like that. So once you get into a RIF, you have to withdraw a certain amount. But if you were to reduce, I mean, take partial income from an RRSP and partial from your dividend, you are reducing that amount as well, so that you have that flexibility of how much you withdraw from your RRSP by not letting it be too high. Does that make sense? I mean,
well, you can manage the clawback a little bit better too, right? Because the RIFs have those minimum withdrawal rules, exactly. Right. So if you've been lucky enough to, put enough away, that then just based on your RIF alone, you're running into those rules.
Not lucky,
all combined. Right, sacrifice exactly. Certain amount of luck involved, but hard work. If your primary savings vehicle is a corporation, you certainly control the amount of dividends you're taking. Yeah. Exactly. And you'll know your other sources of retirement income, so you can really manage that.
Okay.
And when I first gave this talk a long, long time ago, the top tax bracket was 61.91%. It's now 46. So you don't feel too lucky hearing that, but
just one quickly, if you have a method for running a corporation, myself and my wife are two directors called that. Can you add children or grandchildren to shares? Do you have to fix it that the amount or freeze or something, or can you just ask your lawyer to add children and grandchildren, and when they get to age 18, you can pay the grandchild's tuition, let's say, out of dividends?
That's a good planning idea. Maybe they should have been made shareholders all along on day one, because it would be easier, but they didn't. So you have to be pretty careful with sort of tax law and corporate law. You have to pretend that it's not your grandchild. It's me that's buying one of these shares. So I have to pay fair market value. Your corporation might be worth $1 million. That's yours. Any future growth, maybe we can share, but that first $1 million is yours. So you may have to go through an estate freeze, or the shares that I buy might say, remember the share attributes, gee, Doug's going to buy a share for $1. If the corporation wants to buy that back, it can for $1. If I want to cash it into the corporation, I can for $1. So I'm kind of fixated on this dollar amount. But then we have one little extra clause that says the directors, if they want, at their sole discretion, can pay a dividend on that class of share to the exclusion of all the other shareholders. That's the play. So then you, the director, choose to pay, well, I'd be your grandchild, a dividend, and then I'm off to university. So you got to do it just right. But you sort of just sit back and say, well, would you allow somebody else to buy that share for $1? That's the question. So anyway, you're probably best to go through this fancy class of shares that's redeemable and retractable for $1.
And the second question is if your spouse is an American citizen too, like dual citizenship.
We don't like that.
I'm afraid of a spouse.
Well, there's funny rules.
There's an easy way to solve that. If I'll pick on you. If your wife is a U.S. citizenship, I'm not really up on my U.S. gift tax, but if she were to simply give you her shares, she doesn't own them anymore.
Yeah, it cuts out your ability to split income.
It doesn't. Then the corporation pays, now you own the whole company, 100%, corporation pays you a dividend. The Canadian tax rules say you have to split that 50-50 anyway. So I want to research the U.S. gift tax on that idea, but otherwise, her estate tax is going to be zero. She doesn't own anything. But yeah, that's a big problem. And the trouble with going to any presentation on the U.S. tax is you get totally depressed when you hear it. It's all bad news. There's nothing good you can do.
Currently in Calgary, there's a 3-year wait to renounce the American.
Toronto has some sort of express line. They seem to. The consulate in Toronto has actually made some sort of their own streamlined procedure that they have limited. You have to make one appointment at this point instead of 2 or 3. So that's where the 3 years comes from. You have to keep going back with different paperwork. So I've heard that, but yeah, Toronto, for some reason, is a lot more efficient at ripping that citizenship up.
Yeah. When my golf spending account was set up, I think it was set up so my wife and I could spend, I don't know, I think up to 10,000, and then children could spend 1,500. If they're not shareholders, the children, are they still, is that?
That's not an issue, right? Because I benefit from a healthcare spending account at NPT, right? It has to be accessible to all employees. It's more of an employee issue than a shareholder issue.
That 10,000, maybe you can increase that. The test is it reasonable in circumstances?
Okay.
So anyway, just one quick last point on death, and this is not much more than a rant about probate. So it has a nice new name. It's called the Estate Administration Tax. Planning around it is grossly overhyped. We now have a new government department. The Ministry of Finance has hired a whole bunch of people that are going to enforce it. So all of a sudden, we aren't going to be able to get away with murder. And the rates are the same. So I call this a nuisance tax, and I don't really beat my brains out trying to save or get out of probate if it screws up the rest of my tax plan. So the next slide is just a few kind of overhyped ideas, things that we've heard about in the past. How can you get around probate? Jointly owned property. When you die, title automatically passes to the survivor. Most people own their houses this way. Named beneficiaries for RSPs. When you die, the RSP automatically goes to your spouse, tax-free. So you name that person as the beneficiary instead of not naming them. It might go into your estate, and then your will says everything goes to my spouse. Subject to probate if you do it that way. Dual wills, this is probably the easiest thing. Will number 1 says, my corporation goes to my spouse or whatever. Will number 2 deals with everything else. Will number 2 has to be probated. Will number 1 doesn't. Some of the concerns about some of the hokey, I'll call it hokey, probate planning I see is a lack of concern for the Ontario Family Law Act. There's a special treatment in the Family Law Act for gifts and inheritances, plus any income or capital gains are in there from. If it's just a slam dunk bit of crash probate planning, you can mess that up. Testamentary trust, something I have fun with sometimes. Well, if you're just transferring property immediately on death, you're throwing that idea away. That might be gone next year anyway with the federal tax reform, but we don't know. And then, of course, my last point is just some last-minute screw-ups that people sometimes go crazy when somebody's on their deathbed. I had a horrible story here. Mom's on her deathbed, doesn't want to pay probate, so she puts everything in joint name with her son. A couple $1 million, she then dies, all the property goes to the son. And the daughter says, hey, what about me? And so the son was a good guy and said, yeah, I know, here's half. But boy, that could have been a nasty legal fight based on a situation caused by bad advice from the person's stockbroker at the time. So it's just kind of slow down with the probate planning. Anyway, sorry about the rant.
Our very last point, we'd be remiss if we didn't end on a life insurance note in the Temple of Insurance. That we're grateful for Zavitz to have provided the space for us tonight to go on about tax. So we wanted to share with you a few of our thoughts about owning life insurance either personally or your corporation. 2 major considerations. You know, paying the premiums with corporate dollars is certainly a lot cheaper and more efficient generally than having to take the money out of the corp and pay the premiums personally. Also, corporate-owned life insurance policies on death, the half of that death benefit is taxable in the corp, and the other half enters that tax-free realm we talked about briefly, the capital dividend account. So certainly that mechanism. I'm not going to go into the taxation of life insurance. We'd be here until this time next year, but there were some changes in the budget in 2013 that made certain leveraged policies less attractive. Less deferral of income tax exempt policies are just that. They're exempt for, there's no taxation inside the policy. So just something to think about. There's a couple of family law considerations as well. Insurance proceeds received personally are not considered shareable property under the Family Law Act. If those proceeds otherwise were to go into your corporation, though, it furthers the value of those corporate shares, which are shareable property under the Act. So you really have to consider, who's under these policies and where the money's going to go at death. And then a couple of comments about transferring policies out of the corporation, generally not great. There's an income inclusion for the corp. It's not nearly as fun is the transfer in, right? The transfer in, if you hold a policy personally and wish to transfer it into your corp, there's certain tax-free money that can be extracted in the process, depending on a few factors, you know, the fair value of the policy and the cash surrender value. It's a little bit more complex than that, but just so you understand the difference between the options, something to think about.
I'm just confused there. Do you have a key man insurance, the person that is the physician, does the corporation pay the premium or does the person pay?
It depends who owns it, who should be paying the premium generally, but even still those, so the key person insurance, those premiums can be paid by the corporation, but they're not deductible to the corporation.
But the corporation gets the money on that. It's the beneficiary.
Yeah. Which that money's supposed to be there to help the corporation continue, in the absence of that key person. So there's a certain amount of tax paid, and then there's a big tax-free portion as well.
Actually, virtually, it depends how old the policy is. So if you're looking at policies and they're about 20 years old, virtually the whole thing can pass through tax-free. So I won't get into the dynamics, but if you die early in a policy, it's a great return on your investment.
There's some planning.
If you die when you're supposed to die, which is way beyond that, the adjusted cost base of the policy goes down to what we call zero, and so therefore the money flows into the corporation totally tax-free and can flow out of the corporation, 100% of it tax-free as a capital dividend. So it just depends on when you die, early or after 20 years. Does that answer your question? Yeah. Yeah.
Perfect. Thank you for coming. I hope that you were able to hear everything we said and enjoyed, and took at least a couple of tidbits away. And again, thanks to Zavitz and company for having us down here today.
Thank you. Are there any questions? We have a couple minutes for questions.
In an NPC, when you're looking at salary versus dividend, and you're one and the same, in your figuring, did you take into the benefit of the RRSP when you're looking at total wealth, not just the wealth of the employee?
No, I ignored it basically. I said, what would you rather have? 10 grand in an RSP or 8,500 in your corporation? That's the comparison. And so I basically just ignored it. Is there an advantage in an RSP? Yes and no. Depends what you invest in, how long it's going to sit there, and the return on investment. Right. When I was a lot younger, when interest rates were like 12 to 15%, an RSP was way better.
Yes.
But today, my RSP doesn't seem to do much. So if I assume a growth of 2 or 3%, the RSP is way less interest.
Right. Yeah. No, it's such a variable. And in 2008, when it was a bad year, but we've done the math for about 5 years. Do we dividend or do we salary? When you look at what you end up paying to source deductions, it's pretty, well, for a long time, it was better to salary, just because of all the benefits to the corporation. So your overall wealth is what we were interested in.
Exactly.
Yeah. And so that's why I was surprised we based it just on CPP as the criterion.
Well, no, I guess I'm really saying is that salary and dividend, it doesn't much matter today.
Because of the variable of the RSP.
Because the tax rates are about the same. Now, if you owe dividends, you're not able to contribute to an RSP. I guess I'm just saying I don't see that as being all that valuable right now.
I'm curious about the individual pension plan. We sort of skirted over that quickly. If you were setting up an individual pension plan, does it need to start with enough for defined benefits for an actuarially determined lifespan?
Basically, it does. So when you first set it up, which is a real process, the pension plan administrator is probably going to say to you, you have to transfer a whack of your RSP money into the IPP to get it started.
But you have to put, like, for $80,000 a year for 10 years, you have to put $800,000 in to set up the plan.
No, you wouldn't be able to put that all in up front. That's called a past service pension contribution. and you're going to be severely restricted on that. You might be able to put something in, but generally they're going to be looking to your RRSP to fund it. So there's no great big lovely tax deduction right up front, if that's what you're thinking.
No, I just think, I don't read more.
So generally your annual contributions in a perfect world are going to be at $25,000 or $30,000. Similar to the RSP, a little bit higher. But it's when the market tanks that you really have the ability to top up.
Absolutely.
Yeah.
Awesome, thanks guys. Thanks everyone as always for coming here tonight.